You're listening to the Financial Source podcast, your daily dose of sentiment updates in the European and U.S. sessions and critical risk event previews so you stay up to date with what's moving the market right now. Each session is carefully crafted personally by the Financial Source analysts and voiced by our AI hosts who, as it turns out, sound a lot better than we do. Here's Rachel and Michael with this session's deep dive.
Welcome to the Deep Dive. Today we're really digging into the global economy. We're distilling what matters from a detailed market briefing from Thursday, October 16th, 2025.
Yeah, and this isn't just about, skimming headlines. It's about connecting the dots, seeing how foreign exchange, commodities, trade, and even geopolitics are all, interacting right now. It's a very interconnected snapshot we've got.
Exactly. Our goal here is to cut through that noise, find the signals where our market's genuinely cautious, and where's the real momentum. And look, we have to start with this fundamental tension coming out of Washington. It colors everything.
Oh, absolutely. The whole global market story right now seems to orbit around these two, frankly, opposing forces.
Right.
You've got the Fed, central bank, sounding pretty cautious. They're talking up labor risks, the end of balance sheet normalization.
Right, which normally signals, be careful, maybe lower rates ahead.
Precisely. But then, bam, you have the White House dialing up the U.S.-China trade rhetoric quite sharply.
So, cautious Fed, aggressive trade stance. That contrast, that fault line is key, isn't it? It's just creating confusion for global markets.
Complete confusion. And that's exactly why we need to unpack this, starting, I think, with currencies, with the FX.
Yeah.
Because that's where you really see this policy tug-of-war playing out most clearly.
Okay, let's do it. The dollar first. The briefing says it's mixed, maybe a bit softer overall, but it just won't really fall decisively. Why is it holding up so well if the Fed sounds dovish?
It's that political backstop.
Yep.
President Trump didn't just mention tariffs. He called them a national security tool. And then, even more directly, said the U.S. is, quote, in a trade war with China.
Wow, okay.
Yeah, that's huge. For global investors, that kind of language screams risk off. And when global risk flares up, money tends to flow back into the dollar as, a safe harbor. So that aggressive talk puts a kind of floor under the dollar, especially during those quick spikes.
So politics keeps it supported, but how does the Fed's caution actually limit that strength? What stops it from just shooting higher on that trade news?
Well, the Fed's focused domestically, right? They're flagging those rising risks in the jobs market. And they mentioned nearing the end game for balance sheet normalization, basically, slowly shrinking their huge asset holdings.
Which signals they're not exactly rushing to tighten policy.
Not at all. It signals caution about future growth, definitely not an eagerness to hike rates. So that caps the dollar's upside. It forces traders to play the short-term game rather than betting on a clear, long-term policy direction.
Which makes sense. It means currency moves are really driven by policy whispers and headlines, not just hard data. Makes long-term bets tricky. Okay, moving away from the dollar. Sterling seems to be doing well, leading the gains.
It's had a strong run, yeah. Partly supported by, reasonably steady UK economic data, but also fiscal signals. The Chancellor over there has pretty clearly signaled higher taxes for wealthier households are coming in the November budget.
And the market likes that certainty.
It seems to provide a bit of fiscal stability, yeah. Even though, interestingly, the Bank of England is also noting signs that the UK jobs market is softening. So it's not all rosy, but the fiscal clarity helps.
Got it. And the euro, holding above 1.1 seen, the notes say. Sounds like maybe things are calming down a bit there. Less French political noise, maybe some better industrial numbers.
Yeah, moderate stability is a good way to put it. Nothing spectacular, but holding its ground.
Okay. The yen had a weird moment, a quick jump that faded.
It did. There was this brief haven bid, sparked by some hawkish comments from a Bank of Japan board member, CG Tamura. He basically argued they should get rates closer to neutral sooner rather than later to avoid sharper hikes down the road.
But it didn't stick?
Nope. The bigger global risk picture and those underlying dollar flows just took over again pretty quickly, and the yen gave back those gains.
Right. And down under, the Aussie dollar is still feeling the pinch from its own domestic news.
Yeah, still digesting weaker jobs numbers, higher unemployment figures that came out recently.
Even though their central bank tried to smooth things over.
That's right. An RBA official, Christopher Kent, came out saying financial conditions have eased, the cash rate's kind of in the neutral zone, but the market's really zeroed in on that weak jobs data as a sign of domestic softness. The Kiwi, the New Zealand dollar, is doing a bit better, trading more steadily, helped a bit by a firmer yuan fix from China's central bank, the PBoC.
Okay, so a really mixed bag in FX, heavily influenced by political and central bank talk, especially out of DC and London. If policy uncertainty is driving currencies, let's see how that caution, or maybe lack of caution, shows up in commodities, in raw materials.
Well, they're sending almost contradictory signals, actually.
Yeah.
There's a huge divergence between different assets.
Yeah.
The absolute standout momentum story is gold. It seems to be completely ignoring any sense of caution.
Yeah, records being broken, trading above $4,200 an ounce. That feels like the market screaming, safe haven amidst all this policy mess, doesn't it? What's pushing it so high so fast?
Well, it's kind of the perfect storm for gold. First, you've got the softer dollar, which is always a tailwind. Second, those data gaps. Because the U.S. government shutdown is still going on, the market's missing key inflation and growth numbers. It's flying blind, essentially.
And rates uncertainty.
Exactly. And third, those cautious signals from the Fed we talked about. They're fueling expectations that maybe policy gets even easier down the road. Gold just loves that combination.
Yeah.
Uncertainty, data gaps, and the prospect of lower real interest rates.
Okay, so gold's soaring, but then you look at oil, and despite all the geopolitical headlines flying around, it's basically stuck in a range. Why the stalemate there?
It's a real push and pull. On the supply side, you've got genuinely tense news. Reports of Ukrainian drone strikes hitting a Russian refinery. Suggestions some Indian refiners might cut back on Russian crude purchases.
You'd think that would send prices rocketing.
You would. But then you look at the demand side, and it's acting as a powerful counterweight. There was a surprise build, an increase in U.S. crude and gasoline inventories last week. Plus, the demand forecasts from the big agencies, they've been trimmed back a bit, more tempered.
Ah, okay. So inventories are comfortable for now.
Right. And while you hear warnings, like from Saudi Aramco saying underinvestment now means future shortages, which is a valid long-term point, the immediate picture, thanks to those inventories, looks balanced. So you get this sideways grind. Supply anxiety versus immediate inventory reality.
And that cautious tone seems echoed in base metals. Copper, the industrial stuff, is soft.
Yeah, range-bound to softer.
Mm.
And that's a key signal about growth expectations. It ties directly back to China. Their latest inflation numbers, both consumer CPI and producer PPI, were pretty sluggish.
Meaning not much pricing power, weak demand.
Exactly. It underscores a weak price backdrop inside China, which keeps those near-term demand questions alive for anything industrial. So metals are definitely not buying into a strong global growth story right now. It's a really stark contrast to what we're seeing in gold.
That weak signal from China definitely raises the stakes as we pivot to the area that could really slam global demand, trade and tariffs.
Yeah, and this part of the briefing shows the U.S. is playing a kind of dual-track game here. On one track, very aggressive confrontation, especially with Beijing. But on another track, you see targeted, almost practical negotiations happening with key allies.
Let's unpack the U.S.-China standoff first. It sounds like it's getting tougher.
It does. The White House is explicitly keeping that threat of 100% tariffs on the table. And they're framing it now as essential for national security, not just economics. They've even hinted at penalties beyond tariffs. It suggests this isn't just a temporary spat. It feels more like a long-term strategic shift.
And Beijing's response, particularly on those crucial rare earths.
Well, they're trying to manage that carefully. They did just slap some new port fees on U.S. ships earlier this week, so the tension's still there. But crucially, they clarified their rare earth export controls. They're insisting it's not a total ban. They say license applications for civilian uses will be approved.
So trying to use it as leverage without completely cutting off global tech supply chains.
Seems like it. A careful calibration, you could say. Maximize pressure, but maybe avoid total disruption.
Okay, that's the confrontation track. What about the other track, the calibration with allies?
Right. So you see South Korea, Seoul, sounding pretty optimistic they can get some kind of tariff deal with Washington. And it seems linked to a big U.S. investment pledge by a major Korean company.
So trade policy as a tool to reward specific actions or investments.
Exactly. And you see something similar with Mexico. They're apparently negotiating for discounted tariffs, specifically on heavy truck parts. It shows that while the headline rhetoric with China is harsh, the actual policy with allies is much more transactional, looking for specific carve-outs to keep key trade flowing.
Interesting. And meanwhile, back in the U.S., officials are pushing back on claims of tariff dodging for appliances.
Yeah, basically saying there's no widespread evidence of companies trying to cheat the system by undervaluing goods.
Yeah.
But the really big macro issue hanging over all of this, and it loops back to the gold story, is that unresolved U.S. government shutdown. It's still delaying key economic data releases.
Which makes it harder to actually know what's going on with inflation and growth rate.
Critically harder. It just adds this layer of fog right when clarity is needed most. It complicates the Fed's job, complicates trade talks, everything, just unnecessary friction.
Okay, let's shift gears slightly and frame the purely geopolitical risks, those potential flashpoints that could just change the whole market mood in an instant. The Middle East sounds like it's still incredibly fragile.
Very much on a knife edge. The ceasefire around Gaza is technically holding, but the sources mention Israel has contingency plans ready if fighting flares up again. What markets are watching closely are signs of stabilization. Things like U.S. officials talking about better aid coordination or the potential shape of some kind of multinational force for stability down the line.
So, cautious hope, but the risk premium is definitely still there, especially for energy markets.
Absolutely. Now, moving north, Russia, Ukraine. Energy infrastructure is still right at the center of that conflict. And the sources point to this sort of contradictory situation. On one hand, there's talk about potential room for a settlement, but right alongside that, you have indications Ukraine wants to keep pushing its offensive.
And those refinery strikes we mentioned earlier play into this.
They do. The vulnerability of energy infrastructure, especially refined products, means Europe stays extremely sensitive to any shifts on the ground or in diplomatic talks there.
And then there's a new potential hotspot popping up in Latin America.
Yeah, this could be something to watch. Caracas, the Venezuelan government, strongly condemned President Trump's confirmation that he'd authorized CIA operations inside Venezuela. They called it a violation of international law.
And the market implication is?
Potential spillover. Does this lead to renewed threats of U.S. sanctions targeting Venezuela's oil sector or other assets? It just adds another layer of potential instability to the oil market specifically and the region generally. Something new to monitor.
Okay, so pulling all these different threads together, or FX, commodities, trade, geopolitics, what are the absolute essential things the briefing says you need to keep on your watch list right now?
Okay, 4 main things stand out. First, keep a very close eye on the dollar's path, especially how it reacts as the Fed keeps emphasizing those labor market risks and the end of balance sheet normalization.
Got it. Dollar direction versus Fed caution. What's second?
Gold's momentum. Just incredible. It's establishing this new floor, seemingly above $4,200. It's the ultimate hedge against all this uncertainty we've been talking about. Oil's ongoing battle, that push and pull between the geopolitical supply worries, like those refinery hits, versus the reality check from comfortable U.S. inventories. We're basically waiting for that range to break one way or the other.
Makes sense. And the last one.
You have to watch for any concrete, specific moves on the U.S.-China trade front. Is Beijing actually approving those rare earth export licenses for civilian use? And are allies like South Korea or Mexico actually getting those sector-specific tariff carve-outs finalized? Those details matter hugely.
That's the tactical checklist. But let's just zoom out for a final thought. Back to that core contradiction that's running through this whole deep dive. You've got an administration using really aggressive, national security-focused trade language, explicitly saying trade war right.
Right. Full throttle on the rhetoric.
While at the very same time, you have the independent central bank, the Fed, signaling caution, talking down risks, actively normalizing its balance sheet, probably to manage domestic labor issues.
It's more than just a tug of war. It feels fundamentally unstable, like two engines trying to drive the same car in opposite directions. The administration's actions seem designed to create tension, maybe even boost inflation eventually. The Fed's trying to keep things stable, maybe even slow them down a bit.
So the big question is,
how long can that possibly last? How long can these two opposing forces, one trying to heat things up, the other trying to cool things down, or at least keep them steady, operate simultaneously without forcing some kind of major, maybe unplanned policy shift that just completely resets expectations across all global markets? That's the tension I think you really need to be thinking about right now.
An absolutely crucial question for the weeks ahead. Thank you for joining us for the deep dive. We'll catch you next time.
Thanks for listening to the Financial Source podcast. If this podcast helped you at all today, would you consider leaving us a review to help spread the word? Each month, we also give away different resources and indicators just to podcast listeners. So write into Financial Source at support@financialsource.co to claim your free gift today. Talk to you all in the next episode.